Welcome to Facts Pro, where it's all about facts, financial, accounting, and tax strategies. Okay, so today we that will be the final Facebook Live before we take our post-tax season break. So we will be back sometime maybe mid-May. Just keep an eye out on the email. We'll send announcements there. But what I want to leave you with today. What I want to leave you with during this period of time of refreshment, of just sitting down, relaxing, and coming back with fresh energy. What I want to leave you with is all what I always talk about all the time is what is the difference between tax planning and tax preparation. I want you when you think of taxes, you don't think about, oh, I need to file my tax return because I want to get it done. I want you to think about it always as a way of, okay, I can be proactive about my tax situation. I know that I can be in control. It doesn't have to be after the fact. I should be the one in control. So I should be the one planning how much taxes I need to pay, not to be surprised just after year end when it is time to file your tax return. All right, so let me share my screen and we'll dig in with today's presentation. And that will start right away. Okay, so April 15. April 15. Now, okay, it's April 15 is next week. How should we be looking at April 15? April 15 should be a planning deadline, not just the tax day, not just the tax, not just a deadline where you have to file your tax returns. Now we have a new rule. So we don't want just to file, we want to plan smarter for 2026. We want our April 15, our tax return to be our diagnostic report of what needs to be done better for the year we have in hand. Okay, so the main message I want you to get from today that April 15 is not just about getting your return done. It's also the point where your 2025 return should drive smarter 2026 decisions. Again, we have the O3BA rule and law that had changed the conversation which business owner tax moves matter most. Which business owner tax moves that matter most, how to reset the estimates and planning, what to review before and after the filing. This is what I want to cover and that's what I want to focus on today. Okay, so again, why this year feels different? Why have you probably experienced bigger refund this year than in the prior years? Because of the change in law. And this law, as you know, has different deadlines. So a few things have affected 2025, other things would affect 2026. So from a compliance standpoint, you still have to file or extend by April 15 and pay enough taxes to avoid surprises. From the new law perspective, the return now it fees decision around the QBI, the expensing, the entity level planning. Now we need to look at that and to see if that would affect our decision making. So the smartest owners use the filing season data to really adjust for the year they have in hand, to adjust the payroll, to adjust the estimate, to adjust how to plan my purchases for 2026. Okay, so some areas that we want to highlight and to focus on in 2026, number one is QBI. We know that now this is becoming permanent, so we need to use the filed return to see whether our business income, wages, entity structure are helping or hurting the deduction. Because your W-2 income has an effect on the QBI deduction. Have you known this? Do you know how it affects it? You may be losing on this deduction because you're not taking enough salary. So your salary has a role in this. Your W-2 income has a role in this. Expensing. If the expensing rules have improved, now we have bonus depreciation, we have better 179 limits, then your equipment and technology purchases should be planned intentionally, not just rushed in December when, okay, I think I will have a big tax bill. What do I need to buy now? R&D, we know that R&D had a big a change in 2026, and it can go in 2025, and it can go retroactively. So business investing in systems, software, any research and development, they should revisit how those costs are captured and timed, because you want to know whether you should go and do it retroactively. You want to know if you should do it in the year you have in hand. This all needs planning. This all needs a lot of analysis and a lot of estimations. Okay, so what your 2025 return should tell you. If you look at your 2025 return, you should see, was taxable income higher than expected? Did you expect a taxable income? Did you expect that you're going to pay that much? Did you expect that you've made that much money? So look at your taxable income and see, was it higher than you expected? The withholding during the year, the estimate payments you made during the year, did it cover enough? Was it enough? Were you subject to any penalty? Did the entity structure you have still make sense to continue with? Did the payroll strategy you have support the return you wanted? So now you have a finished return. This should be a diagnostic report. This should be a report that if it exposed the tax problem, then that problem is already happening again in 2026 unless you change something about it now. So that's why when somebody comes to me, the first thing I ask about, I wanna see your tax return. This is my diagnostic report. This would tell me whether you have an issue and you have a problem or not. Or not. And if I'm talking to doctors, you know this. You know that if a patient comes to you, you cannot diagnose what they're having an issue with unless they do their blood work. So same thing here. Now you have a finished return. Let's take a look at this and let's see where the problem stands. So from there, we can reset our 2026 estimates. So if the O3BA changes deductions, income treatment, planning opportunities, then the worst move is to keep using last year estimate formula without adjusting. We know there is a safe harbor option, which is okay. But now you need to review, compare your 2025 balance due or refund to your actual cash flow pattern. Now you need to consider your cash flow as well. Recalculate your 2026 quarterly payments after your payroll, QBI, and entity decisions. Coordinate. You need to tie your federal, state, and owner level planning all together instead of handling them separately, because at the end of the day, they feed into each other. Okay. Uh, Three business owner planning buckets. The compensation, you need to review your on the owner W-2 distributions and reasonable compensation strategy. And again, it's not only for like compliance purposes, but it also for like yourself, for health insurance deduction, for your QPI deduction. This can have a factor, an impact there. From an investment bucket, you need to plan your equipment, software, and growth spending around the available deductions. Entity bucket, you need to confirm whether the current structure still supports your savings and admin simplicity, because every single structure has its own pros and cons, and no one size fits all. So you need to check if it works for you or not. Don't just listen to, okay, I had this colleague that had this structure, and they told me just to do the same. Don't do the same. Okay, where owners usually miss the opportunity. So, yes, you file, you feel relief, and you move on. Now tax season is done. Let's just move on. We'll wait. We'll see you next April. No, and sometimes, yeah, maybe you're proactive, you revisit the strategy in November, but in November, December, time and options are very limited. And if some of my clients have reached out late in December, I'm like, I wish you reached out to me earlier when more options were available. Because even in late December, you're losing out on some investment opportunities that could help you on the individual level. So you need to reach out sooner than later after you file your tax return. Yes, take a break, but don't wait too long. And the stress people feel when they don't do tax planning is way higher, and it's really avoidable and it's totally unnecessary. But if you review it now, you reduce your stress level and you increase your being in control. Okay. So simple timeline just for you to keep in mind. Now, decide whether you want to file or extend, estimate what still needs to be paid for 2025 tax year. April 15, that's the deadline. File, extend, fund your eligible contribution, whether it's IRA, HSA, make the first 2026 estimate taxes if needed. Late April, May, review the finished return for the O3B driven planning opportunities we talked about. And when we come to Q2, so sometime in June, you need to adjust your compensation, purchases, estimates before bad habits compound. Okay, what I always tell business owners to review next. So now when you take a look at your tax return, see if you had a balance due or refund. See the QBI outcome. Do you have a carryover? Were you eligible to get to receive it? Are you having losses? Did you benefit from it? Are you above the threshold? Owner wages and distributions. If your distributions are higher than wages, is there a reason why? It doesn't make sense. State tax impact and PTET, the pass-through taxable entity tax questions. And from there, we can do planning review, estimated tax reset, retirement cash flow planning, equipment software purchase timing, mid-year strategy meeting date. When my clients, okay, we filed, we're good. What should we do to pay less now? I'm like, schedule a call with me mid-May, June, just to start planning for the year ahead, for the year we have in hand. Okay, so don't let April 15 be the end of the conversation. Actually, let it be the start of a smarter planning. If your 2025 return surprised you, then your 2026 strategy is probably overdue. O3BA may create new opportunities, but only for business owners who act before year ends. So do not wait until it's too late. Okay, so common plan if you really want to have the post April 15 and an O3B review checklist, or book a strategy session to reset your 2026 tax game plan. Feel free to schedule a call with me after this. I want to leave you with this, to again have some time to reset and come back with more focus on 2026 tax planning. All right, I wish you all the best and we'll meet soon. Thank you so much and take care. Bye bye.